Max Keiser. Welcome to On the Edge. Time now to go to London and speak with Ned Naylor Leyland of Cheviot Asset Management. Ned, old boy, welcome back to On the Edge.
Good afternoon, Max. It's great to be here as always.
All right, Ned. First, I have to ask your thoughts on Warren Buffett's claim that gold is valueless and that it is in a massive bubble. We know you're a big gold and silver bug, so tell us why Warren Buffett is wrong.
Well, I don't want to be too mean to an octogenarian, Max, but I would say, first of all, it looks like you could take this statement one of two ways. Either you could take it at face value and say he doesn't understand what money is, which seems, I would suggest, pretty unlikely, or that there must be some kind of ulterior motive with what he's saying. I actually had a quick look when I saw that article, or rather that story come through the newswires. I quickly Googled value, seeing as he's describing it as valueless, and that came up as the importance or preciousness of something. So the idea that gold isn't precious, I thought was amusing. But I mean, ultimately, you've got to bear in mind that he's releasing this in his, I think it's in his annual report to shareholders, and I'm quite sure that a lot of the people that own Berkshire Hathaway shares are probably investing in gold as well, and I'm sure they're ready to ask him the question. So I suppose he has to preempt it a bit by saying that he's not keen. But Max, his father was the Ron Paul of his era, you know, and I think he had great respect for his dad. His dad spoke a lot about individual liberty and freedom and the need for gold as money to stop the government encroaching on civil liberties. So I think it's rather sad, actually, that someone entering their twilight years could so grimly hang on to what is clearly an erroneous assumption. I mean, you only have to look at the price of gold versus his fund over the last 10 years, and it doesn't make for pretty reading.
All right, and of course, we have to look at the recent past and understand that without Warren Buffett's meddling, without his interference, without his purchase of $5 billion worth of senior preferred Goldman Sachs bonds, or without his interference by buying $5 billion of Bank of America preferreds, these institutions that are widely understood now to have been instrumental in the destruction of Greece, the destruction of the American economy, the destruction of the price discovery mechanism, involved in all manner of financial fraud and financial terrorism. Had it not been for Warren Buffett's meddling, these two institutions, Goldman Sachs and Bank of America, would have gone bankrupt already, and we would have gotten rid of them, like we got rid of Osama bin Laden, like we got rid of Muammar Gaddafi. We could have gotten rid of Lloyd Blankfein and Bank of America had it not been for Warren Buffett's meddling. Why does he feel as though he needs to override the machinations of the market itself? When did he become a propagandist and a nightmare as he is, Ned? What are your thoughts on this?
Well, it's a great question, Max. I think a lot of it goes back to, you know, a long time ago. I think he got obviously co-opted into the sort of collectivist machine many years ago. One would possibly even argue decades ago. And ultimately, you know, his fund is very long credit and consumption. He's whether I can't remember whether it's a formal or an informal advisor to the Obama administration on financial matters. So you could expect him to be a mouthpiece for the state. The state is propping up these institutions in an unhelpful way relative to free markets. So I wouldn't be at all surprised to hear him speak out against gold and pro. I think he said something along the lines of, you can be sure that the housing market will be coming back. Well, really? It doesn't look like that to me. I can't see how that's possible. It looks to me a bit more like the float behind Jaws in the Jaws movies that just keeps basically getting dragged below the waterline. I don't really see how it's possible that the housing market can go up from here, considering what the interest rate environment looks like and where it's likely to go, and the availability of credit for the consumer. It just seems as though he's become a sort of secondary arm of the government and a spokesperson for it.
Right, and recently, of course, just this past few days, he's come out with a statement describing the banks as victims of those who have had to be foreclosed upon after they were missold mortgages, after they were asked to bail out banks who we now know committed massive fraud, accounting fraud, that the Obama administration has had to go out on a limb and grant retroactive immunity for financial terrorism. And he's saying that the banks are the victims. But let's move on, because on this show, when you've been on the show, Ned, we've told people over the past few years to protect yourself against the terrorists like Warren Buffett and Lloyd Blankfein, you need to own silver. Silver has been in a spectacular bull market for 10 years. It's the single best performing asset in 10 years. It's outperformed Warren Buffett stock by something like 700% over the past 10 years. So it's the best performing asset again in 2012. It's been the best performing asset for 10 years. Yet the entire time it's been trashed and mocked more than any other asset. Your thoughts, Ned, for the remainder of 2012 and beyond, and explain for those who are prone to panic why silver is so volatile.
I think this year looks extremely exciting for silver. I think last year was a hell of a ride. We saw some amazing things go on, and we can obviously expect the system to continue to try and trash silver, but that's only because it's the Achilles heel of the banking system, and certainly of the bullion banking system. You know, it will be volatile, and historically it always has, even before the sort of paper machinations that have gone on of late. But ultimately, there's such a confluence of factors going on here. You know, whether it's the massive consumption of, or rather holding back of physical by retail investors, whether it's a bit of institutional interest here and there, you know, Sprott's fund, whether it's consumption in Asia. But ultimately, there are certain things that are going on right now which I think make for a very compelling setup going forward. The technical picture looks extremely good again, which is always helpful. I think a lot of the weak hands that were around this time last year have been flushed out. But I think there's also something very interesting going on relative to the Chinese market. I know I've spoken about the Pan-Asia Gold Exchange with you before. There will be an update coming on that in due course. But I think there's another point to make here, which is that the People's Bank of China at the end of last year came out and banned gold trading outside of the Shanghai Gold Exchange in that particular centre. And that's driven a lot of the regional exchanges, a lot of the people who were offering up different gold products within China to switch across to silver. And I think that there's a lag in seeing this in the price, but I think that's another dynamic that will drive us forward strongly from here. But ultimately, you know, we're talking about a market where there's little or no inventory. There's a growing understanding. People are slowly waking up. You've got the likes of Warren Buffett coming out with these kinds of statements, whether it's about the banks being the victims or whether it's about gold being valueless. These comments, in my opinion, are extremely helpful. Because what it means is, at the margin, those people who are wobblers and are potentially very interested in what the likes of you and I might talk about, they're driven to want to look into it a bit more sort of clearly, because these statements are so far from any semblance of reality that it drives people at the margin to be interested. There are people who will grimly hang on to whatever the mainstream media tells them, and you can expect that to continue. But I think that at the margin, you know, silver will continue to gather momentum, and what we want is what I discussed with you the first time I came on and talked to you, which is physical buying. You know, people to go out there and actually put their dollars, their pounds, their euros, their money to work in the real thing to draw down that very dramatically dwindling inventory. And, you know, no matter what paper is thrown at this market, it will drive a change in price and a future of improved price discovery.
Yeah, well, look at a country like Greece, for example. We said on this show last year that one of the motivations for the banks, the Wall Street banks and the European banks, to attack Greece with hundreds of billions of dollars worth of credit default swaps was to get at their gold. They have 111 tons of gold. Sure enough, the news has come out that Greece is now no longer owner of their own gold reserves, and that the 111 tons of gold are now the property of the Troika. We also said to the people in Greece that to protect themselves against this invasion, they need to buy silver. And of course, silver for the people who owned it in Greece was literally a lifesaver. The same thing for the people in Iceland when we talked to them about this. The same thing now for Portugal and Spain, all over the Eurozone. It's a lifesaver. That's physical buying. And as you point out, when the physical buying increases, banks like JP Morgan are encumbered because of their massive balance sheet encumbrance due to the short sales. Last week, Ned, it was reported that somebody, presumably JP Morgan, dumped 107 million ounces of silver onto the market, trying to manipulate the price down again. I should point out that's paper silver, not actual real silver, but 107 million ounces of contractual futures silver. It didn't affect the price really at all. That shows you some strength, doesn't it, Ned?
Absolutely, Max. And I think, the more overt the monetization programs become, whether it's LTRO or all the different things that are taking place at the moment, there are people who are slowly becoming interested. Funnily enough, the point you made about Greece and their gold reserves now being in play for the Troika, it was quite interesting. I had 2 or 3 emails from people who work within the hedge fund community but aren't maybe quite as focused on the precious metal sector as I am, so asking me if I thought this was relevant. I mean, it's amazing, really, that people who are professionals in the industry and work within the industry could ask such a basic question, whether I thought this was relevant. I mean, of course, this has been coming for a long time, and anybody that observes the euro and the way it's structured knows that the gold reserves of these individual European nations are now going to become in play as the cards fall. But it feels very much like the dam is breaking, and yeah, sure, they may try and grab gold reserves in the meantime, but I think there comes a point at which you will see a more overt form of revolution against the political system. Whether it's from the Civil Liberation Army or just the average man in the street saying enough's enough. And I'm aware of what you stated before, which is that it's frustrating to see people come out short term and make some noise and then disappear back and seem less fussed about what's going on. But I don't feel that. I certainly get a sense that across the board people are becoming more politicised, more aware of what's happening. And I think that, at some point in 2012, you're going to see a major change in the way that people see the confluence of political and financial interests.
All right, let's go back and touch on China and gold. An LA Times article from the past week entitled "China Refines Its Role in Global Gold Market." It says that China is the world's largest producer of gold. They'll soon be the biggest buyer of gold. Tell us, Ned, is this intentional government policy in China? And if so, why? And what is their goal? What's going on there?
Well, that's been the case for a little while, that they've been the number one producer. I think that will carry on. There's a lot of small-scale gold mining as well as growing, industrial-scale gold mining. The consumption is clearly growing. You can go anywhere you like in China and pick up physical, which certainly is not the case in the West. In the West, people wouldn't have a clue. In fact, they don't have a clue where to buy gold. I always think taxi drivers are an interesting, little gauge of where we are with this. I often ask them, where would you buy an ounce of gold? And they just look at me in amazement and go, I haven't got a clue. What I would do about that. But with respect to China as well, bear in mind that we've got this big change at the political level coming up in the autumn, or the fall for the American viewer, where the Chinese Communist Party Politburo are changing around. I think it's over 3/4 of the members are supposed to be changing. There'll be a leader. And I think there's a sense that there is a change of political culture going on, and one wonders whether or not that mightn't be leading towards some kind of overt change in the way that the country's currency is looked at, backed or not. It's difficult to know. The Chinese political establishment aren't exactly keen for people to look at the inner workings of policy. But at the same time, the very fact that they've changed so dramatically towards not just allowing the public to buy physical gold, but aiding them in doing so and rolling out bullion shops across the country, it certainly suggests to me that on a long-term basis, the renminbi is going to have some kind of formal gold component to it. And I think that when that happens, then it's going to set off an amazing chain of events in the global currency markets. And maybe that would come after this major political change. I think it's difficult to see something happening before that, certainly. But it'll be very interesting to see what the new regime in Beijing have to say about global currency markets and where the RMB sits within that.
Okay, so just to be clear here, you're suggesting that when the new regime takes over in China, that there's a possibility that they could look at their currency, bring in some kind of gold component, a fractional gold component perhaps, but some kind of gold component, and of course this would radically alter the entire global monetary exchanges around the world, because now you'd have one major currency with some or all backed in gold. How about the bigger picture in China itself? There's a debate. You've got Jim Rogers and Stephen Roach, who are basically China bulls, that the country's not in a bubble. Then you've got Mark Faber and others who think that China is a bubble waiting to pop. Your thoughts, Ned?
Well, I think that's a difficult one. I think that they are, obviously there's a very important symbiotic relationship between them as obviously important global exporters and the consumers on the other end of the trade. So I don't think there's any way anybody could argue that they won't be affected by the sort of implosion, the ongoing implosion of the Western banking system. I think it's very, very difficult to make the argument that they won't be affected. But having said that, I think that a change in the way their currency is set up would put them in a hell of a lot better position to actually be buttressed from what are, is a sort of storm of potential currency problems going forwards. Personally, I would say that, there's a lot of sort of pent-up Chinese expectation at a low level in terms of their expectation of being able to grow, being able to migrate to the cities, to become more affluent. So I think, the Chinese do have a genuine socioeconomic problem building up, and the fact that they're so tied in with sort of Western consumption is an issue. I wouldn't profess to be a great expert in terms of how businesses are doing within China, but I think on a macro basis, everyone is so tied into everyone else at the moment that it's more about who will move first to support themselves in a sort of protectionist manner. And it'll be very interesting to see what drives that. Potentially it could be driven by the problems going on in the Middle East and who takes what position relative to Iran and Syria, which appears to be on the menu again at the moment. Maybe that will drive a little more formal policy within the currency market arena. At the moment, there appears to be a game of chicken. I don't think that can last. At some point, someone's going to move. I think it's much more likely to be a creditor nation. And it'll be very interesting to see how things roll out this year. I think this year is a key year on many, many levels, Max.
You've been on the show before, Ned, and you've been pretty constructive on Norway. You were a big bull on Norway. You were buying the Norway bonds. You're getting a nice yield on those bonds. Now we've got some folks like Robert Schiller, a housing analyst, who's saying that the housing market in Norway is in a bubble and ready to collapse. Your thoughts?
Well, the housing market's been very expensive in Oslo for a very long time. Bear in mind that really just talking about Oslo. I saw the OECD also complained about house price inflation in Norway. They think they'll have to raise interest rates in order to dampen down that demand. Well, as an owner of the currency, that's not going to bother me. I think Norway is a very, very sound place to park a percentage of one's capital. Ultimately, for me as an investment manager, I'm looking for ways of protecting my clients. It's really as simple as that, Max. And certainly the background to the Norwegian kroner and the Norwegian government bond market looks no different now. In fact, sorry, I take that back. It looks slightly better now than it did when I last discussed it with you. I mean, they have now, I think the unemployment rate's 3%, so that's the published rate. The sovereign wealth fund is $580 billion in size, paying around a $30 billion dividend effectively to the Norwegian government. I see really it being a relative judgment. So in other words, what's your base currency? And how does the Norwegian kroner relate to that? And ultimately, whether or not someone considers the housing market to be too high, and even if the housing market comes down, what I'm looking at is saying, right, it's a relative judgment. I have to own a certain amount of client assets in fixed interest, in cash instruments of one sort or another. I don't want to own gilts. I don't think that the gilt market, the UK government bond market, is a viable long-term proposition. It's not offering me any return. It's offering me lots of very, very obvious risk, in my opinion. Whereas the Norwegian government bond market, while it is relatively illiquid, and yes, if the global equity markets go into a tailspin, it's probably quite likely that traders will trade the Norwegian kroner down on a short-term basis because the oil price will be dropping. But of course, that will be a short-term trade. It won't be a long-term situation because your fundamental bias here is still towards security. A good example would be the Swiss franc, where people never bought, I mean, obviously it's changed in the last 12 months, but historically no one bought the Swiss franc because of yield. They bought it because they perceived it to be a safe haven. And so, I very much hope the interest rates do go up in Norway, and that will improve. Certainly, there are some interesting corporate bonds you can buy in Norwegian kroner as well, which benefit from a rising NIBOR, the Norwegian interbank lending market.
Yeah, Ned, you mentioned the LIBOR rates. There was a massive scandal reported recently. $350 trillion market affected by the LIBOR rates being manipulated in London. Again, London, the culprit. Have you been following this? Your thoughts? Why London? We have Bernie Madoff through London, AIG, Bear Stearns, all the crooks and criminals go through London. You're in London. Do you know any of these crooks? Why are they all in London?
Well, I couldn't profess to know any of them, Max, but it does look as though this hypothecation rule is at the core of all of this. In my opinion, there's no doubt that there's some kind of liberal base in terms of lending customer assets, which is the reason why there's so much business done here. It amused me enormously to see Sarkozy's comment when he had that row with Cameron, where he effectively said that and I must just point out here, I don't normally agree with Mr. Sarkozy on many things he has to say, but he said that Cameron was defending London's status as an offshore financial centre, which frankly, in my opinion, is pretty much on the money. And that would tend to sort of explain all of these things, in my opinion.
Right, but if that's the rehypothecation scandal as it relates to MF Global. But this is another scandal about LIBOR rates, where the daily fixing of LIBOR was telegraphed amongst insiders, a blatant disregard of the regulations. Is this going to amount to any kind of punishment for anybody, or is it going to be just another sweep it under the carpet? We need the cheating or else we all go out of business type of thing.
Well, I wouldn't expect much to come of it. I don't think you would either. And yes, it's a fix, inverted commas, a bit like the London Gold fix. It's just another extension of the general malfeasance and dubious practice that goes on at a very high level. The regulators seem much more interested in very minor issues, which really shouldn't be bothering with, rather than these big issues. But ultimately, it's a house of cards, and they're keener on going around doing some sort of origami buttressing of the system than they are actually investigating anything.
Ned, we're out of time. Thanks so much for being on the edge.
My pleasure.
And that's going to do it for this edition of On the Edge with me, Max Keiser. I want to thank my guest, Ned Naylor Leyland of Cheviot Asset Management. If you'd like to send me an email, please do so at ontheedgeofpresstv.com. Until next time, Max Keiser saying bye, y'all.